Good morning and welcome to the ADS Securities Markets Update. Today we will discuss the US jobs report outcomes and why the US dollar retreated yesterday. Basically, the US jobs report came in with a mixed outcome but mostly negative, leading to another wave of sell-off in the US dollar. And this is because September's rate hike speculations are weakening, while equities in Europe and the US also closed a little lower yesterday ahead of the Greek referendum on Sunday. First of all, the US economy added 223,000 in new jobs in June, while the estimates pointed to addition or around of 233,000 in new jobs. Moreover, May's reading has been revised lower toward 254,000 instead of 280,000. Moreover, the 2-month payroll net revision came in with a surprise on the downward revision with a 60,000 in new jobs. In line with the market estimates, the private payrolls added 223,000 new jobs. However, May's reading was revised lower toward 250 instead of 262, but this is not significant. The manufacturing payrolls also came in less than expected, adding 4,000 new jobs only compared to 7,000 new jobs last month, while it had been anticipated also to add around 6,000 in new jobs. The household employment also came in with another surprise, declining again for the first time since April of 2014 by minus 56 in June compared to an addition or compared by adding 272 in May. The unemployment rate declined sharply toward 5.3% in June, down from 5.5%, while it had been anticipated to decline slightly or to tick lower toward 5.4% only. However, the sharp decline in unemployment rate is basically driven by the sharp decline in the participation rate, which basically fell to 62.2 to 66.6, down from 62.9, and this is even when it had been anticipated to remain unchanged. And this is the lowest participation rate since almost 38 years, or maybe since 1979. The most important factor in this report is the average hourly earnings, which is basically the piece of the puzzle that the Federal Reserve is concerned with. The monthly average hourly earnings again came in with a disappointment, showing no growth in June, while the estimates pointing to a rise of at least 0.2%. Moreover, May's reading has been revised even lower towards 0.2% instead of 0.3%, and this is the most disappointing reading since December of last year. In addition to that, the year-over-year average hourly earnings or the year-over-year average wages unexpectedly declined back to 2% in June, down from 2.3%, and even when it had been anticipated to remain stable at 2.3%, and this is also the lowest reading since December of last year. While the US dollar yesterday also weakened, the job creation in the US remains stable and solid. However, there are two factors that are driving the US dollar downward today. First, the unemployment rate, which basically, or the decline in the unemployment rate, is driven by the fall in the participation rate, and the number of people who are out of the labor force right now has hit already a record high. The wages growth also unexpectedly retreated back in June, and May's reading was revised lower even since the wages are growing between 0.1 to 0.2 on a month-over-month basis and 2 to 2.3% on a year-over-year basis. Then the slack that the Federal Reserve has been discussing is still existing. In addition to that, September's rate hike speculation are weakened yesterday. As a result, the US dollar also dipped across the board, and in addition to that, the US 10-year yield eased back toward 2.36%. In addition to that, and why the move was limited yesterday, and this is the weakest reaction to a jobs report this year, which basically resulting that from the fact that there is a national holiday in the US today or tomorrow, that this is also celebration of the Independence Day in the 4th of July. So most of traders already left for a long weekend. Finally, we'll look also at the final piece of the figures yesterday. We had the factory orders, which basically declined more than expected, declining by 1% in May, exceeding the estimates or the estimated minus 0.5%. Moreover, April's reading has been revised even lower towards 0.7% or minus 0.7% instead of a decline of 0.4%. The core factory orders also increased slightly by 0.1% in May. However, April's reading has been revised to a decline of 0.1% instead of no change. The outlook for the US dollar for the time being remains on the downside on the short term, at least because wages growth in addition to the factory orders data are likely to lead some banks to cut the Q2 GDP again. However, we are all waiting for the Greek referendum on Sunday, and therefore today is expected to be a quiet day ahead of the weekend, and also next week remains the key for now. But regardless, the US dollar remains also well below its short-term trendline resistance and its 100-day moving average, while oscillators are heavily overbought, suggesting another downside retracement ahead. Traders need to be very cautious and very careful regarding the Greek referendum on Sunday, as the market may open on another gap on Monday, whether if they vote in yes or no. But if they vote no, the gap would be more significant than voting in yes. This is it for today. You can follow us on our social media sites, Twitter, Facebook, and YouTube to get the latest economic releases, reports, and analysis, and more special reports. Thank you for watching. We'll see you once again next week. Have a good weekend.